but it's all about individual stocks. And the first one on our radar is Samhi Hotels. The company reported a strong set in the fourth quarter, marked by a big jump in the profitability. We do have Ashish Jakhanwala, who's the MD and CEO of Samhi Hotels. Ashish, it's been a regular feature on our channel because of the recent deal that you had with GIC as well, and that's reflected in the kind of stock price move that we've seen over the last month and a half. But let's speak strictly on numbers for now. For this year, you did about 18% revenue growth, that is FY25 that we're speaking about, margins at around 36%, and your RevPAR increased a fair amount as well. So as you see things at the start of this year, what are your targets for FY26 when it comes to revenues, EBITDA margins, and revenue per available room?
Thanks for having me on the show. So I think we've had a fantastic FY25. For FY26, the early indicators are fairly encouraging, both in terms of performance of the hotels, but also what we're seeing in terms of demand growth in the core markets. So we do expect to maintain a double-digit revenue growth. And of course, we have seen in our portfolio this strong operating leverage. So for instance, if we grow our revenues at 10%, we end up growing EBITDA at about 14-15%. So I do feel fairly confident about maintaining a double-digit revenue growth, and that's without considering the impact of new inventory that we'll end up launching in the middle of the year.
Okay, all right. Hi, Ashish. Good morning. Good to see you, Ben. As always, Street likes what they've seen in terms of your operational performance during the course of the year. What about the RevPAR? What should it look like in the coming year in comparison to FY25?
So, Nigel, I must say you're talking to an entrepreneur who has infinite optimism, but sometimes even my optimism is up for a surprise in markets like Bangalore and Hyderabad, where RevPAR growth has remained extremely robust. While we have always guided towards, let's say, a high single digits to early double digits total revenue growth for same set of hotels, what we've seen over the last few quarters is that our optimism has been beaten by the market, largely because the office space absorption remains extremely healthy. Airline growth continues month on month. So I think we should be able to maintain double-digit RevPAR growth for same set of hotels, really.
All right. So, that's about the same set of hotels that you're talking about. Double-digit growth organically in the revenue, RevPAR, as well as a faster growth on the EBITDA because of the operating leverage nature of the business. If you could give us a sense on, what's your operationalization target for this year? You have about 700 rooms which are in the pipeline. How many of them come on board in the next year? And from the rooms that have recently opened, properties that have recently opened, how much could that contribute to incremental revenue for the company?
So I think we've just launched 2 new Holiday Inn Express hotels, one in Greater Noida and one in Calcutta. We have added rooms to an existing hotel in Bangalore. I think for us, the meaningful addition really happens around middle of the year, middle of the fiscal year, when we add a significant inventory to our Sheraton Hyderabad asset and a market which is really outperforming. And then we also add inventory to our Hyatt Regency in Pune, again, a fairly strong market. So that's really for FY26 that you'll see stabilization impact of the 2 Holiday Inn Express hotels that have just opened and the impact of the addition of inventory in Sheraton and Hyatt Regency Pune. FY27 is a big year for us because we feel fairly confident to launch the W in Hyderabad. So that will obviously create a significant impact for our business. And a year after that, we have the rebranding of the Tribute in Bangalore, which is then going to be followed by opening of the Westin there. So we have a very robust pipeline starting middle of this year till almost continuing till FY28, FY29. And that's really without accounting for any new M&A or leases that we may acquire over the course of the period then.
All right. Ashish, if I look at your mix, the upper scale as well as the mid-scale, upper mid-scale, that's at around 40% apiece. How do you see the revenue mix shape up in the coming year as well as going ahead? What's your targeted mix? And also give us a sense about, GIC and you all did that deal with, with regard to that investment. For those hotels where GIC has invested in, what kind of a growth outlook are you looking at out there?
So, Nigel, I think given the commitments we've made last year, which is for the W Hyderabad, the Westin, and the Tribute in Bangalore, just mathematically, we see the share of upscale going up from, let's say, mid-40s to about 65%. Our upscale inventory is almost stated to be doubling over the next 3 to 4 years, going from about 1,000 rooms to 2,000 rooms. And that's, I think, pretty significant because currently our upscale trades at almost 2x of our portfolio RevPAR or revenue available per room, whichever way you look at it, right? So we would see a shift in the short term of our greater contribution from upscale hotels over the next 2-3 years. In the long term, I think we continue to see tremendous opportunities in the mid-scale segment. But today we don't have a very active pipeline, which is under development. The pipeline is all for what we can acquire in future. So I think in the short term, you'll see the 45% grow to about 65% in terms of upscale contribution. As far as GIC's joint venture, we have two fabulous markets in that joint venture, Bangalore and Pune. Bangalore continues to grow probably at the highest rate in terms of RevPAR across all Indian markets, and we do expect that hotel to continue to outperform. I think the big upside for that joint venture comes as we operationalize the Tribute in Bangalore and then open the Westin in Bangalore. Let's not forget that combined, it's about 360 rooms in a very strong market. And given current performance levels, it's almost about 90 to 100 crores incremental EBITDA from just those two hotels. And then, of course, Hyatt Regency Pune, whereas, we're adding more inventory this year, we'll redo some of the food and beverage over the course of the next 12 months to 18 months. So I think that joint venture, just the seed assets, I'm not talking about what we can acquire collectively in future, but just the 3 seed assets are extremely well poised for growth in the next few years.
I think the reason why Nigel asked you this question, Ashish, is because the last time you joined us on the day of this deal, you said that this portfolio could be about $300 million. Where does this portfolio stand at right now, and what's the glide path through the $300 million?
So I think, Mangalam, we have over the last 14 years built the business on M&A, and of the last few years, also some of the long-term variable leases. I think the fact that we have completely, strengthened our balance sheet, we have strong cash flows coming through the business now. We are jointly looking at some M&A opportunities, some acquisition opportunities, following the textbook that we follow, the underperforming, undermanaged hotels, which can see a turnaround through product, brand, operational management. So we believe between us and GIC that we should be able to secure some incremental opportunities over the next few quarters, and that will allow us to deploy the intended capital that we want to.
And speaking about capital, any immediate need for any other investment? I mean, we understand that you might be in talks with other private equity players as well.
Not really. Not at all, actually.
Not in the near future, right?
Not at all. I mean, there are a few things I can say with conviction. This is one of them.
We just bowled a googly there, and you did a well left out on that one.
No, I think he's denying it.
You're denying it, is it?
Absolutely denying it. I'm saying there are a few things I can say with conviction.
Yeah.
And this no is with a firm conviction.
All right, not leaving it. Actually, a solid defense out there. Thanks a lot, Ashish, for joining in and giving us those details. You're sounding very, very optimistic, but we'll hold you to some of these numbers and wish you all the best for FY26.
Thank you so much, Nigel.
Well, for the time being, we'll slip into a short break. On the other side, we'll continue to focus on markets which have now moved to the low point of the day. We'll also focus on a couple of stocks. Stay with us.